What a crazy, crazy market day. I've got Larry Goldberg to help. He's visiting with me today to help us understand what might be beyond understanding. But before we do that, we're going to talk about the margins that Brian Wang came up with the other day, his analysis, which struck me as extremely interesting, but maybe slightly at least at or maybe above my pay grade, which was another reason to get Larry Goldberg here. Larry's a venture capital angel. He's a serial entrepreneur, and he's one of those fortunates, those few fortunates who gets to have an investment in SpaceX. Larry, great to have you back here today.
It's good to be here.
All right, this is Randy Kirk. You know what to do. Hit the like, hit the subscribe, hit the notify. More and more programs like this with Larry. If you want Larry back, you know what to do. And then, of course, follow Larry at Tesla Larry on Twitter. And he is always popping in, making comments, adding his own thoughts. And I think you'd find him very valuable to follow. Well, Larry, so it turns out yesterday, Brian sent me over his analysis, and I looked at his analysis of the margins, and I'm like, well, I hope so. And actually, his numbers were really close to mine, and I didn't come to them anywhere close to the method that he used. So it was fun that two different divergent methods, we came out pretty darn close to the same number. But I had some confusion about the number and how he got to it. And I'm a math guy, and I love spreadsheets and I love P&L, but I was just not getting there. So I appreciate you coming on. You want to go ahead and put up the spreadsheet, and we can take a look at, and then what we're going to do after that, I'm going to ask you to analyze my approach, see what you think about what I was adding maybe into this. And then finally, I do want to talk to you about the market today. It was a little nutty. And so I'd be curious to get your take on what happened today at the end. All right, so let's share your screen and we can jump in.
Well, we looked at Brian's numbers and somewhat together, and I've taken his numbers and kind of put them into some sort of analytic basis. It's interesting what he's done is he's shown that the increase in the SNX deliveries have quite a big impact on the margin because they are such large dollar priced vehicles. They're literally double the price of the other models in the range. And the other thing is that the margins are somewhat better.
Sure.
Now, we do know that the discount on the SNX was quite significant in this quarter. But nonetheless, even if you allow for that discount, I think the impact is fairly significant in terms of both the revenue and even the margins. So what I've tried to do is incorporate his numbers into the historic way I do my analysis. And I've kind of come up with a combination of his and mine and see where that comes to. And I'll talk about how he calculated his margins. Does that make any sense?
I think you and I have had a little time to discuss this over the last hour or so, and I thought it made a lot of sense. So,
okay, so let's start with, let me start by sharing my screen. Always a lot of fun to do that.
Of course.
And, hopefully you have it shared now.
It is up and ready to go.
Okay, so the way to look at this is to, let me see if I can get a laser pointer up there. Yeah. The way to look at this is both from an historic point of view and from a futures point of view. And we're looking at Brian's analysis as best I can represent it. And what he's done is he's taken the vehicles by category, S and X and Y, and he has taken both those manufactured but also delivered, and what's left in inventory. And what he's done with both the X and the Y, or the 3Y and the S and X, is he's multiplied them by their book selling price to come up with sales and also cost of goods sold. And I have added the line of actual. So
he has his estimate based on his analysis.
Yeah.
You've shown what Tesla actually said
Right.
at the end of the quarter. Okay.
Correct. So what I've done is I've looked at Q1 and seen what the auto sales should have been, what they were, and I've imputed a discount from that.
Okay.
And that discount is what I've used to apply to Q2 sales. Now, there's potential for error there. So clearly, we could have had a larger discount or a smaller discount. And it's unclear yet what the discount was or is. So, on a $100,000 car, 4.2 is $4,200. That's kind of sounds right to me. It may have been higher, but then we had the Y that was, lowered in discount in some markets. In other markets, it may have been increased. In other markets, there was no discount at all. So how that played out, I don't know. If you had asked me that we only had a 4.2 discount in Q1, I would have been quite surprised.
Yeah.
But it makes sense when you actually think it through. And so one way or another, I think I'm just going to take his discount, apply it to the formula that he's used for what the auto sale revenue should have been, and come up with what ends up being the, imputed or the actual or the theoretical actual.
Right.
After you apply the 4.2 discount. The COGS don't change. And here you may have something to say about it, but I've just simply taken COGS as they occurred last quarter and projected them forward. Now we know they're going to change, and you can talk to that.
Sure.
But for the moment, I've just taken the same number and I come up with actually the margins for the quarter. Does that make sense to you?
Yes. Mm-hmm. Does to me. Hope it does to the audience. But yeah, I think you said it clearly.
And if we project that forward in the next 2 quarters, that could be pretty exciting. But that's not, I think, the subject of today's conversation.
Right.
So I think it's a pragmatic approach. Some people will be far more analytic about it than I have been, but at the end of the day, it's
you're guessing. It's how what did we used to say when the computers first came out? We first had our spreadsheets and we first had all the and people were like getting these crazy numbers, and with a phrase, it was GIGO, garbage in, garbage out. That phrase has almost been forgotten. But when you're doing this kind of estimating, I mean, shoot, when I had my own company and it was only in 25,000 square feet, it was hard for me to know how many widgets really were in inventory at any given time. So a few thousand widgets could make a big difference.
Yeah, unfortunately, you didn't have my software. I would have solved that problem for you.
That's true. That's true.
So this calculation gives us an average price of 45,000, which interestingly enough is a little bit higher than last quarter, which that makes sense.
Yes.
We have our deliveries. It gives us an order revenue.
Let's say why that makes sense. It makes sense that the average cost per car would be higher because we have way more Model Ys sold this quarter as a percentage, which are higher priced than the Model 3s. And then we know we had almost double the number of S's and X's, which are much higher. So
yeah, but there's a caveat there.
Yeah.
I didn't calculate for more Model 3s. I'm on Model Ys.
More Model Ys. Okay, yeah.
I took the average of Model Ys that he's just
Right.
supplied.
Right.
So what you're saying is really stuff that you need to address in the next section, because this is part of the, the guesstimation methodology. Let's just take what happened last quarter and extend it to this quarter. We didn't look into that number other than the change in the S and X.
Right.
So, the two variables that really apply, and that is if the discounts were larger this quarter, number one, and number two, if the number of Ys sold versus X's were increased as well. So those are the, and then of course the geographic spread and the impacts that the geographic spread had on the discounts. So that's not in these numbers. In these numbers is this, Brian's theoretical versus the discount that we calculated, imputed from last quarter.
Right.
And we come up with a auto revenue of 21 billion, give or take. We come up with a cost of 17 billion, margin of 4 billion, which means a margin without rate credits or leasing of 19.16%. Just a shade below the 20% that everybody's gunning for.
Right.
They say below 20%, the market will collapse. Above 20%, the market will go to the moon. I mean, this is the kind of nonsense that, market watchers do. But all right. And by the way, that may be true for a couple of weeks before the next nonsense. All right. So the auto revenues show a margin of 4 billion. The rate credits, I've just assumed the same as last quarter. Who knows? There's no way to know that.
Sure.
Leasing, I've added a few leases for the quarter, and I'm showing the same percentage of cost and come out with this margin, standard margin. Energy, I've added a margin. I've taken us up from that 10% mark to the 14% mark. I think we'll do better than 15, but let's leave it at that. Services, I've taken a tad higher revenue, same marginal rate of profit. I think we're going to see significant increases in these profits as the energy, not the energy, but the charging business ramps up. I know you don't think it's a business, but I think it's ramping very nicely. And then that gives us a total revenue of 26 billion. It gives us a total margin of 5.2 billion and a total gross margin of just a tad under 20%.
Okay. Yep.
If we deduct our SG&A, then our income from operations is going to give us 3.273 billion or 13%, which is a nice increase in operating margin. That shows our operating leverage from that very poor quarter we had last quarter. Interest, I show as, inching up slightly. It gives us a pre-tax profit of 3.4 billion and around about a gap of 96, which could be $1 a share.
Sure. And that
so
90,
I don't think there is a significant risk of going below 90. I think there's a significant upside potential. I think you'll talk to one of the aspects of the upside potential, but I think this is a reasonable, balanced view. And I think Brian's done some really outstanding work in coming up with, just the sense of the 3X and the 3Y and the SX and the mix and what that impacts, how that impacts revenue and margin. Make sense?
Yes, absolutely. And I think the number he's come up with, the 96 cents, would be a very happy day for the market. I think the stock would do well if it's 96. And it would also give us a preview of how to look at the future quarters in this new way that might be useful as well. All right. So maybe if you stop sharing, let's talk about some ways. So we're gonna accept that 96, Larry, for the purpose of this meeting. We're saying, okay, the 96 is good, and here are a few things that might help us to, let's say, see that as being conservative, but almost certain to happen. So I have constantly and commonly talked about all these different ways that that margins will go up as a result of cost of goods going down. And so that's what I want to talk about. So one of those would be we sold more Model Ys. In the Model Y, Model 3 mix, we don't get that information in the numbers that they just gave us on the second. We know that the mix is going to be more heavily Model Ys. We know that the Model Ys have bigger margins than Model 3s. Therefore, that should reduce cost of goods or increase margins in some small way. Might not be huge, but it should be at least something. Would we agree on that one?
Oh, absolutely. And, I think that the other issue is the spread, so that where these are sold, and I think that will have an impact.
Right.
Be interesting to see the impact this quarter
of the various markets that they're sold into. Okay.
Geographic spread, right?
Yes. So the next thing is that there's more of the Model Ys were made in Shanghai. I'm sorry. There was more product made in Shanghai. We know that Shanghai had a blowout quarter, and Shanghai's margins are greater than Fremont's and almost certainly greater than Berlin's or Austin. We don't know that for sure, but we can surmise that the fact that Shanghai had a blowout quarter should increase margins. That one?
I absolutely agree with you. I think there's no doubt about it and that's part of the geographic spread. And, and not only not only the Shanghai operation, but also the two new gigafactories, right?
Yes. Yeah. So that would be another thing, is that another thing on the list is that the gigafactories, the two new gigafactories, are further along in their ramp. Since they're further along in their ramp, the cost per unit of the cars made in those two factories should be dropping, and maybe even substantially, which should give us another positive hit to the margins. All right. All right. And then we've got the Berlin situation, or the European situation, where this time last year, and even to a certain extent this time last quarter, the cars now that are being sold in Europe are almost all coming out of the Model Ys, are almost all coming out of Berlin. So that reduces cost of freight, cost of import duties, etc., from anything that would have been still coming out of Shanghai. All right, you're shaking your head yes, so I'm assuming.
Yes, I am. I am in agreement with that.
Okay, all right. The next thing is commodity prices are dropping like a rock. I mean, it's just crazy how fast commodities are coming down. Even gold and silver have joined the crowd. So last month it was all commodities are dropping except gold and silver, and now gold has dropped like a rock this last few weeks. So commodities being down should mean at some point that's going to be hitting the margins. People have argued whether that's going to be this quarter or next quarter. I'm saying that there'll be some part of that commodity drop, especially the battery drop, that I believe battery price drop, which should be showing up in this quarter.
I'm a skeptic. I don't think we're going to see commodity impacted prices this last quarter.
All right. Okay.
I'm not, my own experience is that commodities take a while to work through the system, quite a while.
Yeah. Okay.
Shipping costs, on the other hand, don't. But we now know that both the Y and the 3 manufactured in the US have very, very high US made parts. So the amount of shipping done for, these cars are relatively little.
Yeah, but that is a good point. And the what do you want to call it? the the freight on ships has dropped dramatically, and so
yeah, ro-ro rates plunged in the last quarter, and just given Tesla's relationship with the ro-ro shippers, I think they would have earned a significant decline in that shipping cost. So that is an arguably pretty positive number.
it could be a big number. I know it's certainly, as an import-export guy my entire life, I know that when you see those freight costs go up on the containers, it really can impact your landed cost. Okay, the overall cost is likely the overall lower cost because of the IRA discounts. The IRA discounts are probably allowing purchasers to move up in their in the car that they're purchasing. They're going to be able to buy paint. They're going to be able to buy the interior they want. They're going to be able to buy the dual motor instead of, so they should be able to be going up in model, which could also increase. That's a big marginal difference when they do move up into those categories. Yes, no, maybe.
Yeah, I'd be interested to know what the impact is, because some of the cars you can't add too much before you hit the limit. But I guess for all those cars that are below the limit, yes, there would be that. Now, the impact of that is going to be much greater going forward this quarter and further, because there'll be a point of sale discount.
Starting
to the end of last quarter, it was just a credit, right?
Right. Okay. We also have Tesla's continuously dropping the cost everywhere across the board. So whether that's the cost in the cost of goods or whether that's the overhead, they're working night and day to try to drop costs, and some of those costs should be coming through every single quarter. So we could see just generally some lower cost in margins and also overhead as a percentage of the total cost. And of course, when you make more cars, your overhead as a percentage drops. All of this is, little tiny pieces, but little tiny pieces add up. And then, as we mentioned earlier, the S and X sales were almost double. So that marginal difference should also impact. So those are the ones that are on my list. I think conservatively, we could say, okay, here's a bunch of stuff that might add up to 1% or 2%, maybe even 3%. Who knows? But if we take our percent that we came up with at around 20, we could maybe be solidly at 20 with these numbers. I personally am at 21, and I came to it basically by using this analysis that we just went through is how I came to my 21. We've talked about all the possible ways we can get to 20, 21, maybe even 22% margins. Any summary or any other thoughts, or have we covered it all?
I would just counsel that there are some areas of negative impact on margins.
Okay.
Most importantly, labor.
Sure.
There is definitely a significant pressure on labor, both in the factories, but also in the, operations, sales and marketing, distribution. There's definitely has been a significant upward pressure on salaries and wages in the factory. So I would say that there's a countervailing force that you need to give some thought to, and it could have an offsetting impact. I'm always the bad news guy. But, it's more than possible we're going to be at the 90 plus. Now, there's also I don't know what the odds are, but there's a chance that there could be a downside to this.
Sure.
And they could, if we see the margin come in at 80 or below 85 or below 88, really, there's going to be a very significant impact on the stock price for a period of time. If we see it above 90, it could be a very positive impact. So
when you say above 90, what are you meaning when you say above 90?
The margin, if we see the operating margin above 90 cents, I think we will see a significant increase in the share price.
Okay, the operating margin above 90 cents. I'm sorry.
Not the operating margin, sorry, the EPS.
Yes, okay. All right, let's go back. So I'm gonna make a break here.
Did I say all right?
Okay, Larry. So you've got a possibility. You're saying that labor could have an impact. Then overall, how do you look at going into the earnings report? How do you think this will impact the stock price?
Everything turns on the bottom line. I mean, do we beat? If we hit 90 cents non-GAAP, I think we're in the clear. The market will continue. They'll spin that negatively until it gets to 91, 92, 93. Then they'll pay a lot of attention. Below 90, I think we'll see a decline in the stock price. What could be significant for a period of time until the next part of the narrative plays out. So that's kind of it. And of course the operating margin on vehicles will be impactful, almost impactful as EPS.
Sure.
Because whatever Tesla Q or the analysts can grab onto as a negative, they will grab.
Sure.
And we'll have to see how this quarter that we're in now plays out in terms of pricing, margins, demand. It's very important because one thing's for sure, there seems to be a significant demand for vehicles in general, and we're going to have a better year than was originally projected. So, we have to be a little cautious about how we project our share price out.
Yeah. So, Larry, I'm going to use this moment to announce for the first time that you are going to join me on my Cathie Wood analysis. So because you're on the East Coast, we can't do that analysis Friday night and have it first thing on Saturday morning. So you and I will be meeting sometime early Saturday morning. We'll get it out as quickly as we can, probably midday. But I'm really thrilled to have you coming in and joining me. We'll take a look at, I take a very deep dive. I take a lot of notes. Maybe you do too. And I'm really going to be excited to have you participate in that. Having said that, now I want to ask you as the last thing for today, what happened today? So we have, full employment. We're at 3.6 unemployment. We're really probably lower than that. I mean, we have full employment, but we add 500,000 jobs. And then commodities are down. Inflation is down. Gold is down. The dollar is down. Oil is down. The stock market's down. But then it wasn't down as much as I thought. And last time I looked, it was coming back, looking like it might even be trying to shoot for the green before the close today. We'll know by the time people are watching this, they'll know. But can you make any sense out of today?
Well, I've had a lot of skepticism about the unemployment numbers. Our employment rate, our participation rate is low.
Yeah.
Now I'm told it's because all of us old fogies are aging out. I'm not buying that. I mean, if you look at the actual numbers, yes, the boomers are getting old, but we have an 80-year-old president. Warren Buffett is still burning the market up. I mean, I think that we are at a situation where the participation rate is still very low. I think we have quite a lot of participation to go. My own reading of the unemployment is that the unemployment rate is much, much higher than it currently is.
Wow, interesting.
And so I don't take these employment numbers half as seriously as our Reserve Bank does. I take employment participation and I look at that, and be coming down since the 80s quite steadily. And it's not because we're aging out. So in my view, there's huge amount of elasticity still on employment, huge amount of elasticity. And I think for that reason, you have to rethink what these numbers really mean in the real economy. Now, what they mean from the Federal Reserve's point of view, it's just bad news because they're going to squeeze, which, I've been saying for a long time, it's too much and too long.
Yeah, agreed. 100% agreed. Especially when we're seeing trueflation and if you dig into trueflation and you go behind their numbers, you find that there's plenty of people reporting the same numbers as trueflation. Trueflation is basically just bringing them all into one location and doing the analysis. And pretty much you can chart trueflation is about 2 months ahead of the CPI. So where trueflation was in January, well, the CPI gets there in March. So if trueflation sitting this morning at 2.21, if trueflation is right, in 2 months, we could be sitting at 2.21 and on the CPI, and the Fed would certainly at that point be pausing, I would think.
Yeah, but I think they're going to put it up one more time before we get to that rate hitting, and I think that's going to be a little bit of an overshoot. They've probably overshot already, but look, these are the reasons that I'm not supposed to give financial advice, and this is not financial advice. I give life advice, and my life advice is just don't buy on margin.
There you go.
Any one of these blips in the numbers can lead to a very, very significant overnight decline, particularly in Tesla.
Yes,
particularly in Tesla,
because it moves so much. Yeah.
And so I see the quarterly report on the 20th. Is it the 19th or 20th? 19th. On the 19th, I see that as a great danger for the stock price because of these factors that we talked about, or the risk factors in terms of the report that we talked about. On the other hand, it could go boom. So if you're sitting there with a really good position and it goes down a little, you say, well, that's what the market thinks today. I'm shooting for 3 years time, 4 years time, 5 years time.
Right.
On the other hand, if it does go up, great.
Yeah.
And if you're sitting on margin every night, you go to sleep without knowing what the morning's going to bring.
That's true. That's true. Yes. As you know, Larry, in fact, last time we talked about leaps and we said someday we might do a show about leaps. Yeah. I day traded leaps in 2019, 2020. Yes, it was a good time to do it. I thought I was a genius. I made 33 times my investment that year, but I think I got an ulcer. But
that's why it's life advice, not investment advice.
That's life advice. That's life advice for sure. So I'm not day trading leaps anymore. Yeah. I just buy them and hold them for the long term. But
even holding leaps for the long term can be very dangerous because if the stock just burbles along for a while, and it's happened with Tesla more than once in couple of year cycles, you can just watch your leap go.
I've been there.
So leaps are only for people who actually understand what that means and how what the impact is, and so it's great to do a show on that. Although I hope it doesn't send a lot of people to buying them who don't understand it or don't have the capacity for that risk.
Yes.
So typically, what I advise people. Life advice, not investment advice. Yes. If you're going to buy leaps, don't make it a major portion of your portfolio.
Exactly. Precisely. It's my number one. It's my number two rule on leaps. Number one rule is if you're going to buy leaps, it's a stock that you have major conviction in, which is why the only leaps I've ever bought have been. That's not true. I bought some Cathie Wood leaps, but basically I only buy leaps in Tesla. And the second piece of advice I give people is, yeah, it should be maybe 5% of your portfolio. I mean, if that, yeah, it's play money. But if it happens, it's like VC investing. If it happens, it can be huge.
Yeah. Well, maybe when we do the program on leaps, I'll tell you my story on leaps. One of my good stories. I've got some bad stories as well, but the good story is quite amazing, actually.
All right, we'll do that. We have to do that show. All right. Hey, Larry, it's been great having you on again. Really love it. Great analysis. Please let me know in the comments below, where did we get it right? Where did we get it wrong? Only tell me where Larry got it wrong. No, and then hit like if you want to get Larry back on here over and over again. Hit subscribe. Follow Larry at Tesla Larry. I think I've covered it all. Again, Larry, thanks for being here. And to all of you out there, it's been
I've
great.
only one thing to say as I say farewell. The analysis will be wrong. The only question is how wrong.
That's exactly right. Yes, there you go. Well said. And it's been great talking to all of you.
Thanks, Randy.